If you own a condo anywhere in Bethesda, Silver Spring, Rockville, DC, Arlington, or Alexandria, or you're shopping for one right now, stop and watch this. The rules for financing a condominium just changed permanently. And depending on which building you own or want to buy in, this could affect your home's value or your ability to buy at all. Starting August 3rd, 2026, Fannie Mae and Freddie Mac retired something called the limited review process for condominiums. Here's what that means in plain English. For years, if you put down a strong down payment on a condominium, the bank didn't dig very deep into the building itself. They took a shortcut, checked the basics, approved the loan. That shortcut is gone. Now, almost every condo purchase gets what's called a full review. The bank isn't just underwriting you anymore. They're underwriting the entire building. I'm not a lender. I'm your realtor. Could be. So my job in this video isn't to sell you a loan product. My job is to make sure you know before you fall in love with a unit whether that building is going to sail through financing or, unfortunately, become a headache. Let's break down exactly what changed, what I'm watching for in the DMV buildings right now, and what to do if the building you want runs into trouble. Up until now, when you shopped for a condo, you looked at the unit, the kitchen, the view, the square footage. Starting today, the value of a condo isn't just about the unit anymore. The financial health of the HOA is now just as important as the condition of the kitchen. We're heading into a two-tier condo market. Buildings with very strong financials will hold a value and sell smoothly. Buildings that are underfunded or poorly managed are going to face real financing friction, and that puts downward pressure on price. That is true whether you're talking about a high-rise in Roslyn, a mid-rise in Silver Spring, or a smaller building in Old Town Alexandria. So, what exactly can sink a deal under a full review? A few specific things. Let's talk about the first one. The reserve fund. Lenders want to see that the homeowners association setting aside a real chunk of its annual budget for major repairs. Roofs, elevators, structural work, and reserve requirements are set to climb even higher next year in January of 2027. So this pressure isn't going away, it's building. Number 2, delinquency. If 15% or more of the owners in the building are behind on their HOA dues, the whole building can get flagged as ineligible for financing. Not just for the seller, for every single owner trying to sell or refinance. Number 3, deferred maintenance and structural issues. If there's an inspection report showing unresolved safety concerns, that building can get blacklisted by lenders until it's fixed. Number 4, pending litigation. If the HOA is in an active lawsuit, many lenders will hold off financing there until it's resolved. Now, one thing I want to correct, because a lot of the coverage out there is getting this wrong. This is not primarily about how many renters versus owner occupants are in the building. In fact, the opposite happened here. The old cap that penalized buildings with a lot of investor-owned units was actually loosened earlier this year. So don't assume a building is in trouble just because it has more renters. The real risk factors are the reserve funding, the delinquency rate, structural issues, and litigation. That's where I'm focusing when I'm evaluating a building for clients. If you already own a condo here in the DMV and have no plans to sell, you might think none of this applies to you. It does, and here's why. Your board now knows that if the building doesn't get its reserves in order or doesn't clean up a high delinquency rate, no future buyer will be able to get a conventional loan there. That threatens every owner's resale value, including yours. So to stay financeable, boards are going to do one of two things: raise monthly dues or pass a special assessment. Neither feels great in the short term, but buildings that take this seriously now are protecting your property value for the long run. Let's say you're a buyer and the building you love doesn't pass a full review. Or you're a seller and your buyer's loan just fell apart because the HOA's financials didn't hold up. That building gets labeled non-warrantable. Sounds really scary, but it doesn't mean the building is falling apart. And it doesn't mean you can't buy there. It just means it doesn't fit the standard conventional loan box. This is exactly where having the right realtor matters. I'm not the one underwriting your loan, I'm a realtor. But I do know which DMV buildings tend to run into this. I can help you and your lender get ahead of the documentation before you're deep into a contract. I can point you towards lenders who specialize in non-warrantable and portfolio condo financing when a building needs that path. Here are a few mistakes I'm seeing right now. Buyers falling in love with a unit before ever asking about the HOA's reserve study or delinquency rate. Sellers assuming their building will sail through because it always has, without realizing the rules just changed under them. Owners ignoring a special assessment notice instead of asking what it means for their building's warrantability. Here in Montgomery County, Arlington, and the District of Columbia, we have a lot of older, established condo buildings, which is exactly the profile most affected by this change. If you're condo shopping in Bethesda, Silver Spring, Rockville, Roslyn, Ballston, or DC, you can pull and pay the HOA questionnaire and financials on a building before you write an offer, not after. But you could also wait until afterwards. Let's go through a few questions that I get quite a lot. Does this apply to every condo building? Smaller projects, 10 units or fewer, may still qualify for a simpler review. Most established mid-size and larger buildings are the ones affected. Will my rate go up because of this? Not directly. This is about whether the building qualifies at all, not the interest rate itself. But a non-warrantable building often means fewer and sometimes pricier loan options. Can I still buy in a building that doesn't pass? Yes. Cash purchases and specialty portfolio loans are both still options. You just need to know that going in. How do I know if a building I'm interested in will have issues? That's exactly why I help with pulling the HOA docs early, or I can ask about them and we can possibly flag some red flags before you're under contract, before you spend money on a home inspection. If you're shopping for a condo anywhere in Maryland, DC, or Northern Virginia, or you own one and want to know how your building stacks up under these new rules, let's talk. Drop a comment below, send me a message, or use the contact information in the description. I'll help you look at your specific building or your specific goals and make sure there are no surprises down the road. Thanks for watching. Subscribe for honest, straightforward DMV market updates, and I'll see you at the next video.